Thank you for joining the Financial Brokerage webinar today on linked benefits, the innovative way to sell long-term care, with myself, Brian Lysing, and David Corwin as your hosts. We'll begin the session momentarily. Just a little housekeeping note, all the phone lines are muted. We'll have a question and answer period at the end of the webinar. All questions must be typed. That can be done at the bottom of the control panel on your screen. So I'd like to thank everybody for joining us this morning for the Linked Benefits webinar. And to give you a quick little preview of what we're going to be covering here this morning, we're going to start talking about why people need long-term care in general, why hybrids or linked benefit products might be the answer in some cases. We'll go into who buys these products, where can we help those people find the money, and then finally we're going to get into a detailed description of the different types and styles of products that the carriers make available for you to sell, both annuity-based and life insurance-based. So starting off, what are linked benefits? Well, very simply put, they're life or annuity products that link long-term care benefits together into one policy, and clients get to enjoy all the guarantees that that base life or annuity product brings to the table. Now, why are these even relevant? Well, if you're following long-term care at all and what's happening with elder care in our country, it costs a lot of money, and the high cost of extended care is really the greatest threat to our clients' assets should they become ill or frail as they age. It's a greater threat to their assets than a stock market downturn. That stock market always bounces back, and then it bounces down and bounces back. If grandma or grandpa falls and breaks their hip, they're probably not going to bounce, and they're going to need a lot of care for the rest of their life. It's going to cost a lot of money. Now, that care usually starts as what they refer to as a continuum of care. And maybe they haven't fallen and broken their hip, but they're just not getting along and around as quickly as they used to. And usually starts where somebody needs help with their grocery shopping or going to the post office. They need maybe a friend or relative to help them with that. And then they start to need help cleaning the house. And then they need help cooking meals. And finally, it's going to get to the point where they need help with their activities of daily living, such as getting dressed or especially bathing or transferring from one location to another. Now, if they don't have a relative that lives nearby that is both willing and able to help them out, this is going to cost them a lot of money. They've got to hire somebody to help them do all these functions that we don't normally take for granted. So what does that cost a person? Well, it depends where you need the care, and it differs from state to state. But I pulled these numbers from our friends over at Genworth Life. If a person needs skilled nursing in a 24-hour facility, the annual median rate is $81,000. Now, if you're going to go to an assisted living facility, you can get by for a lot less. So we're talking about $40,000. And then if you choose home health care, it's also about $40,000. But look at where they derive that number from. That's based on a 40-hour work week. Now, there's a lot more than 40 hours in a week. So that means that during the other hours of the week, somebody else is helping you out, and they're not being compensated for this. So if you did need 24-hour care at home, I'd say triple that number, and you're looking at $120,000 a year. Now, given all those numbers, upwards of $100,000 a year, how long are your clients' assets going to last? They're going to draw down that retirement savings pretty quickly. So we need to do something to help folks. The solution in the past has been, one, maybe use your own money. If you're Warren Buffett or Bill Gates, that's great. Most folks aren't in that situation, so they have to go out and purchase long-term care insurance. Now, this is still a good fit for some people, but what we've seen in the industry is that sales have been decreasing. Premiums have been increasing. And a lot of carriers are exiting the market. It makes it a much tougher sale than it used to be. And we've seen less and less people are purchasing these policies. And of course, there are some usual objections to some of those too, which the linked benefits products really address. So that brings us to the solution for today, which are the linked benefit products. And we have seen these sales just increase through the roof. Give you an example of how much. Stole this from our friends at Genworth. Again, they've got just a wealth of resources on this topic. But we can see here the linked benefit sales in millions of dollars, and it was growing steadily 06 through 08, and we see a jump in 09. But if you look from 2009 to 2011, the sales have doubled in the linked benefits market, and I don't have the numbers for 2012, but I would imagine it has gone through the roof and above the screen that you see here right now. So sales are just booming with the linked benefits. If you're not selling them, that means somebody else is, and if they're not talking to your clients already, they probably will be. So make sure you get in front of them first. Now, why are people drawn to these linked benefits? Beyond what I already mentioned about the traditional LTC, the carriers exiting and the premiums going up, the top two drivers that I experience here are the guarantees. One is that the client's premium will never change in one of these products. They're based on a life insurance contract or an annuity contract. That can't change, and they're not going to see a rate increase down the road. And then the other important reason we're seeing an increase of sales is that people realize that the benefit is going to be paid out no matter what. Either they're going to use it for long-term care purposes, or they're going to receive, the family will receive the death benefit or maybe the remainder annuity benefit. So they're not wasting their money. The money isn't going for nothing. They're always going to get something out of that. Now, the products, whether they're life or annuity-based, all have some elements in common. They're all filed as insurance products with the states. And for all of them, the LTC benefit is accelerated for long-term care expenses, so it's going to be reducing the annuity contract value, or it will be reducing the death benefit that could ultimately be paid out. So you don't always get to enjoy both. You're going to see one or the other. And the way to qualify for benefits is to lose 2 of your 6 activities of daily living, which I'm sure I'll forget one, but they include such items as bathing and transferring and toileting and continence and dressing, and then there's a 6th one I'm sure someone will remember. Or you could also have severe cognitive impairment such as Alzheimer's. Those are the triggers, same as what you'd see with the traditional long-term care product. Now, there are several different types and styles of these when we get into the details, but before we jump to the product specifics, I'm going to have David Corwin speak a little bit more detail regarding who would be a good prospect for some of these products. Who should we be looking for in our client files?
Thanks, Brian. I appreciate the chance to actually speak about this particular topic. Yeah, finding the prospects. That's something you really need to kind of focus in on, as well as finding the money. But finding the prospects, those are typically people that are age 50 to 75. Individuals that are typically going to be good prospects for long-term care type of coverage. Prefer to self-insure for long-term care, or have large amounts of lazy money, typically going to be your sideline money, people that have lots of money in CDs or savings accounts, things like that. Also have concerns about paying the ongoing long-term care insurance premiums due to the rate increases that a lot of times that does happen, or looking for additional coverage to an existing long-term care insurance plan, as well as needing liquidity. A lot of these programs have the ability of actually getting money out of them, as opposed to having like a car insurance policy where you pay premiums and you never get any money back if you never have any claims. This would allow you to have some liquidity. Also, you like to want to be able to maintain control and flexibility. And then, of course, finding the money, specific markets like life events for funding. In the business market, non-qualified deferred compensation recipients, bonus recipients, recent sellers of businesses and farms. So pretty much everywhere, you want to just have that ability. And just kind of on a side note here, you're always looking for that market trend. You're always looking for some sort of a hot button that would get a prospect to possibly show some interest in what you have to say. So if you have that ability of tripling their money, like for instance, taking their $100,000 and you're making it into $300,000 for that pool of money for long-term care insurance coverage, which is what these type of products give you, is a pretty cool thing to be able to speak to somebody about. As well as DI, life policyholders and return of premium. I need to go back here. Here you go. as well as permanent life insurance policyholders with no longer need for insurance. So that would be your 1035 exchanges, because these type of contracts take 1035 exchanges, and that's actually a great way of getting some money in there. As well as deferred annuity holders. So if you had an individual with an annuity contract that is no longer needed for retirement or something like that, you can actually 1035 exchange that in to the particular contract. Of course, as I talked about with people with lazy money, people with CDs coming due, homeowners that are downsizing. So if you have an individual that's up there in years and they are no longer needing the gigantic house that they purchased, they would of course sell that and have that have the proceeds to go into a long-term care insurance hybrid type of product. Of course, you have your life insurance death benefit recipients, so inheritance, that sort of situation. Types of linked benefits. There are fewer and fewer on the annuity side, and there's a lot more on the life insurance side of things. But yeah, the single premium deferred annuity as well as flexible premium deferred annuity. Of course, on the life side, Brian will talk about this, but the single pay as well as the multi-pay, and then the linked benefit annuity advantages. Typically, what you'll find with an annuity one as opposed to a life one is you'll have a higher benefit. So, in other words, your 100,000 or your 10,000 or your 20,000 will turn into more on the annuity side for long-term care than it would on the life. However, the life insurance, would be a lot higher there than it would be on the annuity. Funding resource: clients who already own annuity can transfer funds into another annuity. Inflation protection: most long-term care annuity products provide 2 to 3 times that accumulated value, as I was just saying that when I was talking about higher benefit. Also, of course, they have that inflation protection endorsement. Underwriting: here's a key feature about these type of products is that they are a lot less stringent on underwriting than what a standalone long-term care insurance policy would be. So you actually that's a great benefit for getting involved in these type of sales. And then of course you have the annuity products, the annuity care through State Life, both 1 and 2. You also have the long-term care fixed annuity with Lincoln Financial. And then what's also entered into the fold here probably within the last couple of years, maybe even a year or so, has been the annuity riders. Actually Aviva, American Equity, as well as Fidelity and Guarantee have entered into the marketplace with a doubling effect of the income payment. So you have the Income Edge, the Edge Plus rider, the Lifetime Income Benefit rider with American Equity, as well as Protection Package with Fidelity and Guarantee. Those last 3 there don't require any underwriting at all. That's actually kind of a cool thing as well. But the Annuity Care 1 and 2 key product features: issued as single life or joint life, dollar-for-dollar benefit, long-term care fund grows at a higher percentage rate, no medical exam or liberal underwriting. As I was saying before, these type of products don't have hardly any underwriting questions. And of course, option to purchase rider to extend benefits for lifetime. Annuity Care 2 has that built-in continuation of benefits rider, and they're approved in all states except for New York, New Hampshire, and Connecticut. And then of course you have that, what I was talking about before, the annuity income riders. That's where that Income Edge Plus with Aviva rider features. Income rider will double. Income payment is confined to a nursing home. As I was saying before, these 3 type of features or riders that I'm going to be talking about have no underwriting at all. So of course no medical, which is a great thing as well. So no underwriting. Eligibility on that Income Edge Plus with Aviva cannot be confined at date of contract issue. Must be confined to a qualified care facility for 180 of the last 250 days. Benefits must begin no earlier than year 2 of the contract. Written recommendation by a licensed physician is also required on that. The American Equity one is the latest one to enter the marketplace, and this one's pretty cool. It's, of course, no underwriting. You have a compounding effect on the actual value that goes in, so the 100,000 would be credited with a 6.5% or 7% growth rate for 10 years. And of course, if you can't complete 2 out of the 6 ADLs, so it's just that I guess what everybody's familiar with, that 2 out of 6 ADLs that Brian was talking about earlier, is the triggering on that. So your income payment would actually double. And of course, eligibility can't be confined to the day of contract issue. I think that's kind of that's something that's kind of, I guess you would call it, would be understood anyway. You couldn't be confined when you took out the contract. Benefits must begin no earlier than year 2 of the contract. Fidelity and Guarantee also has a couple. Has one here called Protection Package. It's their income rider. It's similar to the American Equity one. The actual roll-up rate isn't as fruitful as the American Equity one. It does guarantee a higher income stream, up to double the standard guarantee withdrawal payment. Will pay for home health care, assisted living and nursing home care, and of course there's no underwriting on this as well. Contract must be enforced for 5 years, so not just the 2 years with American Equity, with no additional premium payment paid in the past 3 years. Annuitant is 60 years older, and of course, like with the American Equity one, it must meet 2 out of the 6 ADL guidelines. And I think this is really where we start talking about handing it back over to Brian here on the life side. The annuity one is annuity options are less than what the life ones are, but I'll let Brian speak here for a little bit. Here you go.
All right, thank you, David. And if any of you have further questions on the annuity-based linked benefit products, be sure and call in here and ask for David or ask for Jim Guinan, and both of them would be able to walk you through an individual client situation, because everybody's going to be a little bit different. One thing to keep in mind with the annuity-based linked benefits is that oftentimes if a person has been previously declined for either traditional long-term care or a life insurance-based linked benefit product, they may not be able to qualify for the annuity-based contract, but that would be something to research into ahead of time. It's far better to do the pre-screening than to send in an application and get a decline and then try to figure out what to do. So I highly recommend the pre-screening and asking a lot of questions up front. But to give a little more detail into the life insurance-based hybrids or linked benefit products, I've sort of categorized these into two columns here, the single pay variety and the multi-pay. Now the single pay, if anyone has heard of linked benefits years ago, it's more than likely the single pay products. They were the original hybrid policies. I know when I was out in the field over a decade ago, I was getting invitations to seminars explaining these, and I really couldn't even grasp it at the time, but they've become more commonplace, and a lot more people are familiar with them. The single pay varieties, they appeal probably more to self-insurers, someone who has a lump sum of money already set aside, more than likely for long-term care purposes. Now, they probably won't tell you it's for that purpose. They're going to say, well, that's for emergencies. And then you just have to look them in the eye and ask them, what emergency is going to cost you $100,000? Is your home insured? Would all of your appliances cost you that much money if they all went out on the same day? And just try to get that information out of them that money is really in case they need long-term care down the road. And what we can do with those single-pay varieties is leverage those dollars. Now, the variety of linked benefit that folks tend to be less familiar with are the multi-pay variety. It appeals to a much broader market, and we'll see some premium examples here in just a few seconds. But a person can pay an annual or a monthly premium. It's going to look just like the life insurance policy they already have and they're used to paying premiums on. And this makes this sort of product affordable for people who don't have access to that big lump sum or don't have the ability to tie up that money in one of these products. Some numbers I didn't have a chance to put on a slide here. We had some figures from 2010 as to average premiums for both the single pay and multi-pay, just to give you some idea how much money is involved here and what you can get paid commission on. The average premium going into the single pay products in 2010 was just over $72,000. So again, we need to get clients in that 50 to 100 plus range. The average was $72,000. And what did that buy them? That bought them an average face amount of $123,000 of death benefit. Now their LTC benefit in some cases may be greater than that, but that's usually what you're going to be looking at. Now the multi-pay products, the premiums averaged about $6,000 a year. And that might be comparable to a traditional LTC product. And what did that $6,000 buy them? It bought them nearly $400,000 of death benefit, which could also be accelerated for long-term care. So if you're looking at the time value of money, maybe the multi-pay model looks a little bit better for some folks. But I'm going to go into a little more detail on the single pay next. And I took a 60-year-old male. I said he's in good shape here, good health, and I plugged the numbers into Genworth's total living coverage. I could have chosen several, but this is the one that seemed to be the quickest to run on the software. And if this gentleman puts in $100,000 as a lump sum, it purchased him just over $200,000 of death benefit. If he never needs long-term care, his family will receive $200,000. That's a lot of leverage off of $100,000. Imagine how long it would take him to invest $100,000 somewhere, and then to pass $200,000 to his family after taxes. He'd have to live a long, long time or have just a tremendous rate of return, which you're probably not going to get these days. Now, on top of that, look how much he has available for long-term care. He's got over $400,000 available for long-term care. That's likely to last him, probably more time than he's got on his clock right now. So a pool of $400,000 for LTC, or if he never needs to use it, $200,000 goes to his heirs. That's a lot of leverage off of that original $100,000. I know David spoke a little bit about funding sources, but where are you going to find the money for these single premiums? It'll be in existing savings. It'll be languishing in CDs in the banks, getting a 0.5% rate of return if you're lucky. It could be in existing life insurance policies that have cash value. It could be in a 401k, a 403b, or even in existing annuities. Now, ultimately, when you move those monies, there's a tax that has to be paid, and we've got a carrier that has a mechanism to help mitigate that tax hit to the client. The single-pay products that are out there from our companies, one of the first ones out there was the MoneyGuard product from Lincoln Financial. Genworth Life started their total living coverage when they hired a bunch of people away from Lincoln Financial and made sort of a copycat product. The products are very similar, little nuances that differentiate the two. And then we also have another one with simplified underwriting. You don't get quite as much leverage. You don't have to do as much on the underwriting side. That's through National Western. And if a person is looking for a traditional whole life chassis, State Life offers 3 versions of the asset care based on a single lump sum premium. They also have a second to die version of those if you have a husband and wife and you'd like to put them on the same policy. In a lot of cases that makes sense because we know the chances of a person needing to use long-term care in their lifetime is about 1 in 2. When you're dealing with a couple, if you have 2 people with a 1 in 2 chance, I'd say you've got a 100% chance that one of them is going to need care. Which one? We have no idea. If you put them both on the same policy, now they're covered. And I had mentioned we have a carrier with an ability to move qualified funds or annuity money on over. Well, that's the State Life asset care product. The 2 is meant for non-qualified annuity money. The 3 is meant for qualified money. I don't have a slide that goes into more detail here, but basically they will do a direct transfer from the existing location into a State Life annuity. There's no taxation there. Then that annuity is essentially bled out over a 20-year time period. Think of it as an hourglass. The money drains into the whole life product, which has the long-term care benefit attached to it. And that way the tax hit is about a 20th every year for 20 years, a 20th of what it would be otherwise. So they still have to pay the tax, but boy, you can really lower the effects to the client by using that those 2 products that State Life offers. Now, we talked a little bit about the single pay. What about the multi-pay? Well, here's an example of how this works. And I tried to base this on the same benefit we had earlier. Our 60-year-old, he put $100,000 in, and he got a just over $400,000 LTC benefit. What if he didn't have $100,000? What if he would like the same benefit? All he has to do is pay about $6,800 a year, and he has a $400,000 pool available for long-term care. Also a $400,000 death benefit. If he uses the LTC benefit, it's going to reduce the death benefit that would go to his family. If he never uses the LTC, his family gets the whole $400,000. So that's a lot of leverage on those dollars right there, especially if he needs care or if he dies early. He's going to get a tremendous return on his investment, so to speak. Now, where can we find the premiums for these multi-pay products? Existing life insurance policies. You might want to 1035 over from an existing contract or add to what a person already has. Certainly their regular income coming in. Maybe you're dealing with folks that are taking required minimum distributions from their qualified plans. Well, let's move that money into something where we can give them some leverage rather than reinvesting it into another vehicle that they might not need right now. And there could be other savings vehicles that people have as well. I might talk a little bit about how the carriers pay out the benefits. I said they accelerate that death benefit for long-term care purposes. Well, they all have a different way of doing it. Some will pay the client a monthly benefit expressed as a percentage of the face amount. AXA and Transamerica do that. You're usually going to see 2% of the face amount per month, which equates to about 24% per year. One carrier will act a lot like Priceline.com. You've probably seen those commercials on TV where you name your price. Well, you can do the same thing here. This is with Protective Life. You can name ahead of time what your monthly benefit dollar figure is going to be. The more you'd like available, the more the rider is going to cost you, but the client has the ability to name that dollar figure right there. We have a few carriers that will determine your annual benefit based on underwriting and actuarial factors. Now, this gets really complicated when you look at the wording from the carriers, but basically they're going to look at the time value of money and current interest rates, the extrapolated terminal reserve, along with the health of the client at the time of the claim, and they're going to determine basically what kind of life expectancy do you have left. The healthier you are, the less we're going to give to you. The closer to death you are, the more money you're going to be able to get out of your policy early. And then we have a couple other carriers that will give the client a one-time benefit. This is also determined by underwriting and actuarial factors. It's usually a larger number. One of the carriers accelerates up to $250,000, and the other will give you potentially more than that, and it almost works like a life settlement, but bypassing the life settlement company. So lots of different ways to pay that out depending on what a client is comfortable with receiving there. Give you an idea of how prolific these have become. Look at all the multi-pay linked benefit carriers we have here. I think there's probably about 10 of them offering a permanent plan of some kind, and the newest thing has been offering this benefit on a term life chassis. Now these also usually include a critical illness benefit, and this could be used as sort of a starter policy for younger folks who aren't quite ready for a permanent plan. It certainly makes the coverage a little bit more affordable, again thinking that down the road the person will have the funds to purchase a permanent plan. And we've also had some folks selling these as a supplement to a high deductible major medical plan because of the critical illness component. If they have a heart attack or have cancer, they may be able to tap into those dollars to help them with their out-of-pocket expenses. And of course, they also have the long-term care benefit included there. Some other differences we could look at with these products that are out there. Well, there's actually 4 here that I've listed. Reimbursement or indemnity payouts. Do you need to have the state-specific long-term care continuing education credits? There's a couple tax codes that cause some differences in the products, and some require Paramed and some don't. So give you a little more detail on those. A few of the companies use the reimbursement model. They'll either directly pay the provider, or they're going to require receipts for services provided. Other carriers really don't care. As long as you've lost your 2 of 6 ADLs, you qualify, they're going to send you a check every month. And another way to look at the differences would be the tax codes. The 2 that govern these products are the 7702B and the 101G. If you see any riders on a product that include the words long-term care, you know that they filed it under the 7702B. These are usually paid out on a reimbursement basis, and an extension of benefits is allowed. What that means is, say your death benefit is $100,000, your long-term care benefit could be greater than $100,000. Now, not everybody offers that, but at least they have the ability to under that tax code. Now, the 101G, that's actually the more common one that carriers are using. They have lower administrative costs tied to that, and usually results in lower expenses to the clients. The premiums are lower, but they can't use the phrase long-term care. if they file it in that tax code, they have to come up with something else like chronic illness accelerated benefit rider. There are less restrictions on the uses of the proceeds. Your LTC benefit is limited to the death benefit. It cannot be greater. And another thing, the condition, your loss of ADLs has to be deemed to be permanent, which means you're not breaking your hip and you're getting better. You're not getting better. So a little more restrictive, but you're not paying as much for it either. So you really get what you pay for with these products out there. Another way to look at this, I know we do have some folks that don't want to take any more continuing education than they have to, maybe don't specialize in health insurance-related products. If that's the case, we have several carriers that don't require you to take the state-specific long-term care continuing education credits. Some carriers do, and it varies by state. So if you haven't taken that already, you need to be aware that you may need to get that taken care of before you go out there and sell one of these products. And then we always come across some clients who just don't want to go through the Paramed exam. Maybe they're elderly and don't want to go through that, or they don't like being stuck with the needle, or maybe some people just want the coverage in force a little bit faster. So we do have a few carriers that will offer the product without that full Paramed exam. They'll go off of the questions answered on the application. They'll check the MIB. They'll probably conduct a phone interview, but they're not going to send Paramed examiner out there to see the client. I've got an overview here of all the different carriers and the products and or riders on the life insurance side that are out there. When I first started doing these linked benefit webinars a couple years ago, the list was probably half this size, and now we've got probably 3/4 of our carriers offering something along these lines. Every 6 months I have to add another product or a carrier to this listing, so they're becoming more and more prolific as people, again, are gravitating towards linked benefits to receive their long-term care coverage. So to conclude the webinar here, your clients really need protection. The high costs of extended care are really the greatest threat to their assets they're going to face should they become ill or frail as they age. And as an agent, you can offer protection in any form they prefer, whether it's traditional long-term care, it's an annuity-based product, it's a life insurance-based product. There's going to be something out there that's going to be a good fit for every client that you get in front of. And this webinar was done in large part to make you aware of everything that's out there. Most people just don't even know what the answers could be to their clients. So I guess we've got to the questions portion of the webinar right now, and keep in mind you can type your questions in here on the screen, and we'll get to as many as we can today in the time allotted. As you're typing those, keep in mind though, we're never too busy to see who else we can help over here. If there's someone else you know who should have joined us for this webinar, or who you think would find value in this information, by all means don't keep us a secret. They might be a long-term care specialist, could be an annuity specialist that you know. Maybe it's a registered rep that manages a lot of money that likely isn't protected. Maybe it's a life insurance specialist you've run across that doesn't have a clue what we're talking about here. Or maybe it's a health insurance specialist who's looking to diversify their business right now. We do pay that $1,000 referral bonus, and there are plenty of those to go around. So keep that in mind as you run across other producers out there. And I'll check here and see what questions we have. And we do have a question here about what's available in the state of California. California is a little challenging sometimes with product approvals, but state life asset care products are certainly available, and Transamerica has recently made their products available both on the UL and the term side of things. In almost any other state, everything is available. There are a few restrictions in Massachusetts as well. And we got a question here as well. What life product is the most popular? What do we see sold the most? And boy, there's probably two that I would mention. One would be North American, just because they include their rider in all of their products. And then also Transamerica usually costs a little bit more than North American, but they have, in many states, a money-back option built into the product. And we have a little more assurance as to exactly how much is going to be paid out at a given time here. And let's see here. We've got Some other questions coming in here. Does financial brokerage offer a lead program related to these hybrid products? And that's a great question. We're not a lead company. However, on our website, under the sales tools and training column on the far right, you're going to find a whole host of resources that can help you get in front of prospects. It could be something as simple as a workbook on how to ask referrals effectively. But we also have systems if you have existing clients where we can actually produce a newsletter that you could email out to them, or we could actually email that out to your clients on a regular basis. If you want to get in front of brand new prospects, there's a couple ways to do that. We have the Leads on Demand system. That one is geared for doing a mailing campaign, and we can help you craft a mailer or help find some pieces from the carriers. And that system will let you go in and choose a target audience. You're going to be able to purchase the names for just a few pennies per record, and then all of that gets downloaded into an Excel file for you. You could do the same thing via email with our new Prospect Finder system that's also out there on the website. And I think we have a piece pre-made that talks about the linked benefit products that you can email out to brand new people and get in front of them that way. We do also have some discounts that we offer to all of our contracted producers through some actual lead companies. If you'd like to use those, that's available out there as well. And we do have another question here on the partnership plans here too, and I forgot to mention that that's something that's available with traditional long-term care insurance. Folks can protect assets against qualification for Medicaid if you have a traditional long-term care partnership plan. The linked benefit products have nothing to do at all with the partnership. So if you're interested in protecting assets that way, you do need to purchase a traditional long-term care policy. And let's see what else we have out here. All right. Well, that seems to be the end of the questions. If there was something you were thinking of asking and lost your train of thought, feel free to give us a call. We can be reached at 800-475-5555, and just ask for Brian or David. And, of course, anybody in the life or annuity department can help you with these as well. So thank everybody for joining us here today. Don't forget, next week we have our Sales Summit right here in Omaha. I hope that you folks will be able to join us here for that session as well. Have a good day.